Alright, for this video we want to go over a sample California non-resident or part-year resident income tax return. So these are filed on California Form 540NR, and in this example what we're going to look at is a taxpayer that has to file as a part-year resident. So the non-resident and part-year resident filed on the same form, the 540NR, but in this scenario we're going to look at a taxpayer that started the year as a California resident. Then they moved out of state, moved to Florida midway through the year there to take a new job. And so we need to still file a California return to account for the income that was earned while the taxpayer was a resident of that state. So the California return we have in front of us. We'll go through all the relevant pages that are required. And as always, the state return also includes the Form 1040. So California, as well as many other states, require that you really do your 1040 first, because a lot of this information will flow into the state tax return. So we'll go through both of those pieces, and then in addition to that, we do have two slides here. The first one covers some background information on the fact pattern that we're going to be working with, and then the second one just covers some additional notes on some California adjustments and things that we need to be mindful of as we go through the forms. So let's start with the slides and we'll move on to the 1040. We'll kind of go through the 1040 fairly quickly so we can spend some more time on the California return itself. So in this fact pattern here we have Emily Q, taxpayer. She is a single filing taxpayer and a resident of Florida as of the end of the year, but she started the year living and working in California, and later moved to Florida after accepting a new job with a company in Miami. Right, so Emily moved on April 1st, 2022. So for the first 3 months of the year, she was a resident of California working for Company A, and the wages that she earned while she was working for that company was $30,000. Now, at the end of the year, that company sent her the W-2 showing the amount of income she earned while she was working for that company, and it reported the $30,000 in federal and CA source wages. Now, while working for the company B in Florida, so the new job, she was paid $117,000 for those 9 months remaining in 2022. So her total compensation was $147,000 during the year. $30,000 was from the California company, California source, and then the remainder was Florida source income. Now, in addition to her wages, she had some investment income. So she had a U.S. bank account that paid some interest of $305 for the whole year. And then she had a U.S. brokerage account where she notes on the 1099 that she was paid qualified dividends of $950 for the entire year. And then within the brokerage account, she also had some stock sales that resulted in long-term capital gains. So the interest, dividends, and capital gains were recognized on the following date. So why do we do this? Well, taxpayers, so individual taxpayers operate on generally a cash basis. That means when you work for the income or receive it and it's actually deposited into your account, that's when you record, that's when the income is realized. So this is especially important for part-year residents because part-year residents will have to allocate their income to each state effectively based on when they were a resident. So if we look at the interest income column, for example, Emily pulls all of her monthly statements and she records, okay, on this date I received this much interest, on this date I received that much interest, and so on and so forth. And so she draws a line here to highlight when did I change residency, California to Florida, and then that's how she separates out the income amount. So the dividend payments on the 1099 detail show that, well, of the $950 in dividends that I was paid during the year on my investments, only $237, so there was one payment of $237 that was deposited on March 8th, and then everything else came after. Everything else was paid out when I was a resident of Florida. So when I apportion my income to California, these are going to be the only amounts that are attributed to California source or earned in California while it was a California resident. Right? So that's effectively how it's working here. So you notice how this can be quite substantial or important, particularly with things like capital gains, right? So the stock sales, she didn't sell those stocks until she was based in Florida. If she had sold some stock early on in the year, let's say in January, well, she'd have to allocate that income to California and pay California taxes on it. So very important here to be as precise as possible. And this is much more accurate than simply taking the yearly totals and just kind of apportioning them as if they were earned evenly throughout the year, because we know that's generally not always the case. All right, so next slide, let's cover some of those California notes, and then we'll start looking at the return, and we can see how we separate out some of these sourcing issues. So the forms that we're going to be completing are the 540NR, right? Again, it's the non-resident or part-year resident return. And we're going to need to complete Schedule CA for 540NR. And the Schedule CA is used to make adjustments to your income. So adjustments for not just non-residents, but part-year residents or even full-year residents have to make additions and subtractions to their income to arrive at what is considered appropriate for California reasons. And then there's an additional column for California's source. Now, here's what's really important to remember. And if we look at the return really quickly here, when you do your 540NR, you have to calculate your income as if you were a California resident the whole year. And then after that step is completed, then you can start to pinpoint, well, what's the California source piece? And then how do I, impose the tax on that amount? So California non-residents, California part-year residents, you have to compute your total AGI and your California taxable income, again, as if you were a resident of the state for the whole year. And once your amount of California tax is calculated on that total income, so the CA and the non-California source pieces, that effective tax rate is then applied to the California source income. So you start, again, you compute your, what your income tax would be in California if you were a resident, and then you take that effective rate and then you apply it to just the California source piece, and that's the tax you owe. And we'll see that process when we get into the details on the 1040. Or sorry, not the 1040, the 540NR. Now, if you need some additional guidance on how to account for these items, changing residency to or from California, they have a publication, FTB publication 1100 has more guidance, and they have some examples in there as well that cover these kind of issues. All right, so let's have a look at the 1040, and then we'll get into the 540NR for Emily here. So the income, wages, line 1A, so she's got two W-2s, right? She's got one from the first company, second one from the second company, but their total taxable wages, $147,000. That includes the $30K that's going to be apportioned to California, and then the other piece that is attributed to Florida source income. So the federal return, reporting everything, right? So for federal taxable purposes, we're reporting all our income, and it's only when we get to the California return do we kind of pinpoint what is just California's source. So she's got her interest, she's got her dividend income there, the capital gains, she's completed the 8949 and the Schedule D, so we have the sale of the stocks here, the amount of long-term capital gains that were applicable. And then once she completes the rest of the 1040, then she can move on to the California 540NR. And so that's what we'll jump to now. So starting with page 1 of the 540NR, at the top here, top left-hand section, we enter the taxpayer's tax ID number, first, middle initial, and last name, address, and then the date of birth is listed under the address. Now, Emily is a single filing taxpayer for federal purposes. You generally use the same one for the state. So she's indicated single there for single filer. She doesn't have any dependents. She can't be claimed as a dependent on another return. So when we talk about the exemption amounts here, she gets one personal exemption of $140. And what we'll later see is the $140 has to be prorated because she's a part-year resident, right? So if you're a full-year resident, you likely get the full exemption. But in our case here, because she's a part-year resident, only has a portion of California source income relative to the total, she's going to have to reduce this exemption amount, and we'll get to that calculation later. Now, in page 2 of the 540NR, we've got the line 12. They asked us to enter the total California wages from our federal W-2s. So the California company provided the W-2s showing California wages of $30,000. We've entered that there. But notice we have omitted the wages that are sourced to Florida, right? And that's because the Florida wages are not California wages. So we just have the $30,000 there from California. Now, line 13, we start our kind of calculation here with our federal AGI. Most states do this. Most states ask as a starting point to use your federal AGI, and then you have certain adjustments and subtractions, or adjustments which are either subtractions or additions, to arrive at what is considered your state taxable income. And that's because states and the federal government have different methods in a lot of cases as computing what should be your taxable income. All right. So in our case here, we don't have any adjustments, so we're pretty lucky. If we take a quick look at the adjustments page, I'm going to jump back to the 540NR and then I'll come back to this, but the adjustments are here, right? So in B and C, subtractions or additions to your federal taxable amounts. So what would be an example of something we would see in here? Well, what we often see are issues with interest income. So municipal bond interest income would generally create some kind of adjustment. If you had U.S. Treasury interest, right? So U.S. Treasury interest is subject to federal income taxes, but it's not subject to tax at the state level. So you might have some adjustments. Other adjustments we see are with things like HSA contributions. Line 5, so income from businesses, rental real estate. California doesn't allow things like bonus depreciation. So if you have bonus depreciation being taken at your company level, you might have to add that back for California state tax purposes. So a lot of different items in here could create an adjustment. In Emily's case here, her tax profile is pretty straightforward other than the part-year residency thing. So she doesn't have any items in B or C that we have to worry about. Okay, so once we determine that lines 14 and 16 are necessary because we don't have any additions or subtractions, our adjusted gross income from all sources is determined to be $151,106. The standard deduction allowed for single filers for 2022 for state purposes is $5,202, and so the net taxable income here, total net taxable income, right? This is both California and non-California source, is $145,904. Now, when we look at how we compute our tax rates, so the FTB 3800 and the FTB 3803 generally used when you have children, other dependents that have unearned income, typically investment income, and you're trying to include that with this return to pay the tax on it. You have some different, a little more complex tax computations. Line 31, generally what we're doing is we're using either the tax table or the tax rate schedule. The tax table can be found in the form instructions. This can be used if your income is $100,000 or less. In our case, our income is $145K, so we can't use the tax table. We have to use the tax rate schedule. So the tax rate schedule is a different document which shows the relevant ranges based on our filing status. And so what we have to do is look at, well, what's our income, and then calculate the amount of tax that would be owed based on whatever range we fall within. So if we look here, for example, our income is $145,904. So if I take $145,904 and I have a look at the range here, so we're at $145,000 we're within this range, right? The 66,000 to 338. So the tax computation is whatever our income is, the excess over 66,295 plus 2918. So if we want to see how that math works, so 145,904, the excess over 66,295. So 79,609 times 0.93, right? So 9.3%. Gives us the $7,403 amount, and then we add the fixed amount here, 2918.91. So the total taxes using the tax rate schedule is $10,322. So if I look here, there it is, $10,323. Now for us, we use tax prep software to prepare these forms, so software spits this out nicely for us, but if you were computing this manually or preparing the forms by hand, you can go through the steps that I just did to figure out the tax. All right, so once that's done, now we have to take a closer look at, well, what's California source income and what's our California adjusted gross income? So this is where we jump back to the Schedule CA 540NR. So in Part 1, the residency information up here, we want to indicate that we are a part-year resident, and our domicile, as of filing this form at the end of the year, we're a Florida resident, right? So we left California completely. It's not as if we still consider ourselves to have a home or apartment or any kind of presence there. So we have indicated that Florida is our domicile. We did not become a California resident during the year, so that's why we left line 3 blank. So we've indicated that, well, we actually left the state, so I became a CA non-resident and entered a new state of residence. So Florida became a resident April 1st, 2022, all right? And we leave line 5 blank because we were not a California non-resident for the whole year, right? We were a California resident for at least a part of the year. The number of days we spent in California, 90. So the first 3 months of the year, we didn't travel back at any point during the rest of the year. And Emily did not own any property in California. Now, prior to 2022, you have to indicate your period of California residency. If you left the state during the current year when you're filling this out, so 2022, the ending date you can leave at the last day of the prior tax year. So December 31st, 2021 was the last day prior to 2022 starting. And then the starting point would be, well, when did you establish residency? So let's say Emily was living in Maryland at the time, and then she moved to California November 1st, 2017. She would indicate as such there. All right, so now let's look at how we figure out where we indicate what's California source and what's not. So the income adjustment schedule, again, this includes the adjustments, so subtractions or additions if we have any, to establish what is our income under California law. But then the last column, column E, is where we indicate, well, what portion of the amounts we see in column D are actually CA source. So on line 1, we've indicated $30,000, which is our California source wages from that first job. So $30,000 of the 147 is California source. And then we do the same thing for our interest and dividend income. So recall on our first slide here, we have interest and dividend income. The totals are 305 of interest, 950 of dividends. And the amount that's attributed to the California residency, these first couple entries, 74 of interest, 237 of dividend income. And so we've indicated 74 of interest, 237 of dividend income on line 3. And then on line 7, our capital gains or losses. None of this is going to be characterized as California source because we sold all of those stocks while we were a resident of Florida. Now, different rules would apply if this wasn't publicly traded stock, right? If you had a business, let's say there was a closely held business that you were still running, that's California based, could have some California source capital gains. But when you sell things like publicly traded stocks, it's treated as the sale of personal property, and so the source is going to be based on where you're a resident, right? So that's why it's 0 for us there. Now the rest of this schedule is going to be fortunately blank for us. Keeps it pretty simple because again, Emily doesn't have any of these kind of adjustments to income or other unique items. So when we look at the totals here on line 27, the total amount of income, right? Total, so that's CA and non-CA sources, 151,106. And the California source income is $30,000 or $30,311. Now, Part 3 is used if we need to make adjustments because we are itemizing our deductions. We are not itemizing deductions. We're claiming the standard deduction. So you can leave those items blank and skip down to Part 4 where we calculate our California taxable income. So the $30,311, that's coming up from the page above that we were just looking at. That's our California AGI. The deductions we have is the standard deduction, so there's that $5,202 amount. And here we need to figure out how much of the deduction, the standard deduction, can we actually claim. So this is where we are going to have to prorate or reduce the deduction based on the amount of California income we have relative to the total. So the deduction percentage, note it's asking us here to go back to Part 2, line 27. That's what we were just looking at. Divide column E by column D, and that's going to be the percentage up here. So if we go back up here, line 27, column D and column E, so $30,311 is that 20% of the total. And so that's why we're getting this factor down here, 20.06%. So if we take our 0.2006 figure times the standard deduction amount, that's how we arrive at the adjusted standard deduction amount that we'll be able to claim, $1,044. So we have our California AGI, we have our subtraction for the piece of the California standard deduction, and we have our net California taxable income of $29,267. Now once we have our $29,267, we can go back up to the Form 1040-NR, pages 1 and 2. So line 35, there's our $29,267 figure. Right, so we've computed our total taxable income, the total California tax that would apply to that, right, assuming we are a California resident the full year. We have our California net taxable income figure. And now we need to figure out the California tax rate and then the California tax that would apply on just the California tax income. So the CA tax rate, divide line 31 by line 19. So we have our California tax divided by our total taxable income, so California and non-California sources. So the effective California tax rate, if this were to be the tax, would be 0.0708 or 7.08%, right? Now the California tax before the exemption credits, we take our line 35 California source taxable income multiplied by the effective tax rate, and we get our California tax before that exemption and before any other tax credits. So $2,072 is, at least for now, the starting point of our California taxes on our California source income. All right, $2,072. Now, even though you're a non-resident, part-year resident, you still can claim a piece of the exemption. So remember, single filer, no dependents, she gets an exemption amount of $140, but because she's a part-year resident, she's not going to be able to claim the entire amount. You have to reduce the amount based on the relative amount of your California taxable income to your total taxable income. So when we look at the exemption credit percentage here, it asks us divide line 35, that's this figure here, by line 19, and enter the amount, right, which is 0.2006, and then multiply it by the $140. So if we take our 20%, so 0.2006 times the 140, we get our $28 adjusted amount. So the total tax, $2,072 minus 28, gives us the adjusted California regular tax before credits of $2,044. Now, that is pretty much all the tough calculations, to be frank. The rest of this are special situations where you might have additional credits, but in most cases, these are not going to apply. Right now, every case is different, so you might have things like to worry about renter's credits or AMT. But in Emily's case here, she just has the $2,044 in tax that she's liable for on her income in California. She did have California income taxes withheld, right? So on that first W-2 from the California company, they withheld $2,250 of California state income tax. So because the amount of taxes withheld exceeds her taxes owed, she is going to get a refund. So the amount of taxes that was overpaid for Emily is going to be $206. That's the amount that she can either choose to roll forward to next year if she wanted, but she's not a resident anymore, so she doesn't think she's going to owe for 2023. Or you could donate it or just have it refunded to you. So in Emily's case here, she's going to have the amount refunded to her, so she's going to get a check in the mail for $206. Or, of course, she can complete this information here and have the $206 directly deposited into her account. All right, so that covers it for this tutorial. I hope this was helpful. I tried to go slow and cover all the calculations, but if you have any questions, certainly feel free to leave me a comment below. Happy to answer as many questions as I can. And as always, I look forward to seeing you again on the next video. Thank you.